Happy Monday out there, Team 42. It's your skipper here, Darius to present our macro minute for Monday, August 4th, 2025. Hope everyone had a great weekend. So, as always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk or to get on the right side of market risk to the extent you haven't been following Kiss and Dr. Mo, you need to be a client of 42 Macro. So, today's key macro question is, should POTUS fire Powell to correct yet another policy mistake? Our answer? Probably. President Donald Trump said he would name a new Federal Reserve governor and Bureau of Labor Statistics chief in the coming days to support his economic strategy amid fears that the Powell Fed is in the process of making yet another policy mistake, which will be the fifth major policy mistake of Jerome's tenure. I recall they over-tightened in Q4 2018. They were too late to ease in the first quarter of 2020. They were too late to tighten in 2021 to 2022. And then they were obviously asleep at the bank supervision wheel in the first quarter of 2023. Director of the National Economic Council, Kevin Hassett, former Fed Governor Kevin Warsh, current Fed Governor Chris Waller, and current Treasury Secretary Scott Bessent are all under consideration for the open Fed governorship following Adriana Kugler's resignation. This person would likely assume the role of Fed chair once Powell's term ends in May. His term could end sooner. Section 10 of the Federal Reserve Act allows Fed governors, including the chair, to be removed for cause. Whether the Fed's construction cost overruns qualify as cause will likely be litigated, eventually requiring a Supreme Court ruling. The Fed must begin shedding many of the broken academic theories, like the stupid Phillips curve, that continue to misguide the institution into producing bad outcomes for the American public. This requires a change in leadership and an infusion of fresh ideas to combat legacy groupthink. You know what would be a new fresh idea? Try not using the most lacking indicator of the business cycle to set monetary policy with. How about that? Anyway, getting back into this, it may require amending the Federal Reserve Act itself in terms of getting rid of the legacy groupthink and shedding the broken academic theories that continue to cause this institution to create horrific outcomes for so many families and businesses across our country. The stakes are simply too high in this fourth turning for continued monetary policy failure. Investors who fail to position for significant regime change at the Fed over the next few years will likely continue to underperform those of us who have been anticipating this outcome for years. Transitioning to our 42 macro dashboard, as always, a wrap up with a question from our community. This one's titled Lacey Hunt, Weakening Global Economy, Fed Error, and the Kindleberger Spiral. Says, hi, Darius. I've been reading Lacey Hunt's quarterly review and outlook for years. As always an interesting read. His latest brings up issues implying higher risk of an extended global recession and serious consequences of a decline in U.S. dollar liquidity, which I have not heard anyone else talk about. I would love to hear your thoughts about this article. So obviously I didn't read the article. Don't have time to read everything that people pop into my inbox because when you run a research business, people pop stuff in your inbox all day, every day. And so I read about less than 1% of it. No offense to anybody that pops things in my inbox, but I'm obviously a busy man with a young family, so I don't have time to read for 50 hours a day. But anyway, I can just infer based on the name of the question or based on the title of the question what our friend Dr. Hunt is discussing. So I don't disagree that this is a emerging risk. We talked about in our most recent Around the Horn how the Fed making a policy mistake is a negative outcome for risk assets. And heaven forbid we get a bad inflation report or two or three, and this man Powell starts talking about hiking rates again. I mean, you want to go from things are fine, paradigm C party to potential, Fed policy mistake meltdown. Yeah, it could happen. We've seen it happen several times in Powell's tenure. We saw it happen in Q4 of 18, but from them over tightening. We saw it happen in Q1 of 2020. They weren't getting the memo. We were positioning for deflation back in January of 2020. The Fed didn't start cutting policy rate until early March. Like, what were they doing? Obviously, they were late. They were late in 2021, and that cost them, significantly slam on the brakes in 2022. And obviously, they were asleep at the supervision wheel in 2023. I mean, I can go on and on about these massive policy errors. These are significant, meaningful policy errors that have significant impacts on consumers and businesses across our country, particularly those trapped on the bottom of the K-shaped economy. And so ultimately, if they're going to make another one of these policy errors, then yeah, we got some market risk that the markets may need to price in. Today, it's not pricing in that risk, at least, as of 11:30 this morning. It's not pricing in that risk because, in our view, we think the markets are starting to look ahead to who is Powell going to be replaced with, and is the probability of that person being more dovish or less dovish than Powell. The likelihood is that that person is going to be more dovish than Powell. It's again, we just think it's a policy error to be guiding monetary policy on pending inflation data that is going to go up for some transitory period of time because of tariffs. That's missing the point, Mr. Powell. Respectfully, in our opinion. Could we see a significant decline in liquidity? Yeah, if the Fed makes a policy error, you're going to see dollar up, everything else down. You're going to see dollar up, Treasury bonds up, and everything else down. That's very likely to occur if the markets really get wind of this policy error. But on the other side of it, I think you have a real push-pull between the markets looking ahead to the new Fed chair, the new governor who will ultimately be the new Fed chair, versus the current policy mistake. Does the market have the gumption, and is there enough balance sheet capacity out there for the markets to trade through that and look through what is likely to be the worst part of the U-shaped economy we've been calling for since April? That's the second half of 2025. The economy is going to be the worst in the context of the U-shaped economy. The bottom left side of the U, is the second half of 2025. So the markets, they're going to need some positive policy signaling to look through that. And if they're getting the opposite of positive policy signaling, then yeah, you very well could have some significant impacts on asset markets and the economy. And with regards to the weakening global economy, could we have a global recession? That to me seems unlikely in the context of where fiscal policy is headed across the world. You got obviously Europe remilitarizing, NATO taking its defense spending from 2% of GDP to 5% of GDP. It's not overnight over the next 10 years, but we know the delta is higher. Now that the U.S. and China are firmly engaged in this, this trade war beef, it's very unlikely that the PBOC could continue easing monetary policy in a very significant degree, because ultimately that will cause the yuan to weaken, and then you would ultimately see it create more negative outcomes from the perspective of negotiating with the U.S. on trade. They can't afford to have a significant devaluation of the yuan right now. So that ultimately means that fiscal policy is likely to be the dominant driver of any growth slowdown, the dominant response to any growth slowdown in China coming out of Beijing. So that's Europe, that's China, and then obviously we have a little bit of a fiscal retrenchment here in the U.S., but we know we have peak positive fiscal impulse coming over the next few years, starting in 2026 as a function of the one big ugly bill. So those are the three largest economies in the world that are all, either actively implementing easier expansionary fiscal policy, or are likely to implement expansionary fiscal policy in response to a slowdown. So it's very unlikely that we see a global recession. It's our view that, we're sticking with our paradigm C view. We still think we're in the worst part of the U-shaped economy. It would feel a lot better to asset markets if the Fed and other policy, the Fed was playing ball in terms of supporting us in the worst part of the U-shaped economy, but they're actually implementing, in our view, yet another policy mistake by not doing so. So we'll wrap it up there. Hopefully that was helpful. At the end of the day, I would say, no change to our paradigm C view. We still think, stocks and risk assets will be much higher in price, 12 to 18 months from now. We think, the dollar will be much lower in price 12 to 18 months from now. Bonds, could probably be around the same price 12 to 18 months from now. We shall see. But that's about it. That's our views for now. And if we change them, we'll change them. So with that, we'll wrap it up there. Darius here presenting our macro minute for Monday, August 4th, 2025. That's what I got there today. We'll catch you back here tomorrow. Cheers.